Aren't you glad you're not there?
Seriously.
I am. All right, so right as we get into our next segment, you know, when it comes to investing your money, you have to be careful not to fall victim to common investment mistakes.
Yeah, that's true. If your investments have been less than successful or horribly unsuccessful, or if you don't know where to start, certified financial planner and president of the Shakiba Group, Trevor Shakiba, is joining us with tips to help you score big when it comes to investing. Hi, Trevor.
Hey, how are you guys?
Doing
Very
well. How
well,
about
thank you.
yourself?
Doing great.
So let's say, you know, we have a little bit of a nest egg, some savings, and we don't know where to begin. Because I think for a lot of people still, investing is this mysterious world of what the heck?
It's a whole nother language.
Yeah, well, I think you should always start with a plan, basically in everything that you do, but really determine what you're trying to achieve, then back into it, and that can help you determine how much you should invest, how aggressive you should be. That, in my opinion, is the starting point.
So let's start with some of those, the 6 biggest investment mistakes to avoid. And the first one has to do with emotion. Don't let the emotional side get the best of you.
Yes, you know what? This is the biggest mistake I see everyone make. It's probably worse than all of the others combined. And so what I see a lot of folks do is they go from greed to fear, greed to fear. And so in 08, 09, rampant panic and fear, everyone wanted to sell.
Pull out of the market.
Which is the exact wrong thing you want to do. And then in the late 90s or in 2007, everyone is jubilant and they want to buy. So you've got to remain steady and disciplined, focused on your long-term
We
goals.
saw a little bit of this emotional investing that you're talking about just in the last election cycle,
Right.
which
Yeah.
is common for an election cycle.
Yeah.
But your advice, though, is if the stock market crashes one day or really climbs, that's not the time to panic.
No, never ever panic. You got to remain calm and focus on your long-term financial goals. And I would actually say when you see a dip or a correction, that's actually a great time to buy or invest.
So speaking of invest, can you give me like a 30-year example of what the difference is of maybe doing only 4% of your income versus doing a 10% of your income maybe into your 401k?
Yeah, exactly. You referenced my favorite statistic. I've said it on here before, but if you take any 30-year period in the market and you just invested it in the S&P 500 index, you're going to see about 9 to 10%. But the average individual investor sees about 4%. Which is terrible, and that's because they're doing the wrong thing at the wrong time and letting emotion affect their investment decisions.
That's a lot of money you're missing out on.
Well, and also, it's not just those investing and getting 4%. What about people who are afraid to invest, and maybe they're in like a safe savings account at 1%?
Yeah, and actually in that case, they're actually losing money. And the way they're losing money is because inflation, and then of course taxes, so it's opportunity lost. But you're also losing money. You're going backwards. It doesn't seem like it, and that's why it's so important to have the right portfolio.
You're going backwards because the percentage you're getting is lower than even inflation.
Things are getting more expensive.
I think sometimes folks think, oh, I have to have like $1 million to invest, but you don't. You can start with something small. Yes. Hey, what about over diversification?
Yeah, so this may seem counterintuitive, but to be diversified, you really only need 15, maybe 20, 25 positions, and you have a great diversified portfolio. If you have 100 different mutual funds at 7 different financial institutions, that's not good either. You actually own nothing pretty much by owning everything.
Really?
Your tips also, you say paying taxes, that's actually a good thing.
Well, I think what I put here is don't let the tax tail wag the investment dog. And what I mean by that is that if you have an investment or a stock that's highly appreciated and you don't want to pay taxes on it, that's not a good reason because you still want to be diversified. You may need to sell some and pay taxes. And remember, if you're paying taxes on something,
you're making money.
You've made money.
Yeah.
So that was
those taxes. So let's move on to our next tip. Okay, so what is it? Approximately 14% since the election. Just really, you can keep it simple.
Yeah, and this goes back to the election and the volatility. I put it in because of the last 9 months. Don't let politics influence your investment decisions. Look, no one could have predicted what happened on election night. And certainly no one, not even me, and I'm super optimistic, could have predicted that we're up 15+% since the election. So keep it simple.
Oh, you added an extra percentage point on me there.
It's really, the market's really done well. I mean, obviously, we're at 21,500 plus on the Dow approximately. If you would have sold because of this person winning the election, you would have been penalized greatly because you did that.
It's also just, do you remember a few years ago when everyone was like, oh, I wonder if the stock market will ever reach 9,000?
Yeah.
Is there a ceiling to the stock market? Do you remember that?
I do.
And now we're at 21,000. Incredible.
Right.
Sorry, I interrupted you.
Are there some areas that are doing better? Like, should you do, I don't know, should you do the energy sector, or you know, where should you start looking to put your money? If you're that person that goes, okay, I have $1,000 to put in, where should I go?
Well, you should be diversified
Okay.
because picking winners and losers is a very, very difficult thing. So if you put it in energy, who knows if that's going to go up or down. So you want to own everything, every sector, be diversified. Make sure you're in healthcare and technology and consumer staples and blue chip stocks. And you can do that with mutual funds or index funds, even with a small amount of money.
Trevor, your last tip is to never, ever bet against the United States of America.
Amen. And you know what? I stole this from Warren Buffett. He says it all the time, but it's true. If you look back historically, America has been a phenomenal, phenomenal bet. Things are getting better. Technology, medical advances, cloud computing, 3D printing. So you want to be optimistic. And when you look back historically, optimism is the only realism. It really is.
So buy American and invest American.
I think that you do want to have a little bit of international, but the point is that you can't make emotional decisions because of this doom and gloom. There's always going to be something to worry about. Buy great companies, invest for the long term.
Yeah, and that long term, again, I think that the takeaway for me, the big one, is that 30-year period. If you're getting 9-10%, that's a heck of a good deal. That's a lot of money.
It's an
Trevor Shakiba,
amazing
thank you
difference.
so much.
Thank you
for coming by. Guys, if you would like more information or to start investing with Trevor and the Shakiba Group, visit their website, theshakibagroup.com.
Coming up next, are you trying to eat gluten-free? Well, Chick-fil-A has something new.